it's important to know your deal, not only to know, the pitfalls or opportunities in any transaction, but it's also if you're out talking to equity or talking to debt or talking to an intermediary, the more you know your deal, the more confidence you have in your deal, the better that you can articulate what the intent is, what is the opportunity, what are the challenges. I mean, that is first and foremost the most important thing. If you just have a deal and you bring it to a lender and say, here, what do you think? Everyone is extremely busy right now.
Listen, everybody, we all know that real estate is the most proven way to build wealth. But why isn't everyone wealthy from real estate then? It's hard to know where to start, and most of the education out there is just complete trash, and you end up investing your money on a series of courses instead of in real estate. That's not how this podcast works. We give you the blueprint to successful real estate investing and bring on guests actually willing to share their secrets. I started my real estate investing journey as a freshman in college when I bought my first duplex and have been in the trenches doing deals ever since. And today, I now own hundreds of millions of dollars of investment property. On this podcast, you will learn what you actually need to know to be a successful active or passive real estate investor. And we'll offer our takes on what's happening today so you can navigate this market and build wealth. I'm Drew Brenneman, and this is the Brenneman Blueprint.
Welcome to another episode of the Brenneman Blueprint. Really happy to have you here today, listening or watching on YouTube. And for today's episode, want to do another callback episode to an episode that came out really early. I think it was episode number 6. The episode I did with Steve Kundert. So Steve Kundert is a debt and equity intermediary at CBRE. I've used him for a couple dozen loans at this point. So I've used him for most all of the Freddie and Fannie business I've done, and also some other bank loans that we've done. So Steve's been a really big resource and really added a lot of value to our business on the debt side, and I've really learned a lot from him over the years. And the reason I want to bring this episode, let's say, back to the top of the playlist or stack or whatever it's called, and have it come out again, is he really just went through and just provided tip after tip after tip and just like crushed it in terms of the advice. And, since it's episode 6, the podcast has grown really a lot the last year and a half. And so if, you came in and maybe around episode 50 or 60 or something, maybe you didn't scroll all the way down to the bottom and you didn't notice, or if you did, this one you passed by. And I want to highlight it and say this was one of my favorite episodes, not for any other reason other than just the tips were very high quality from Steve. I mean, a lot of the guests have had very high quality tips, but a lot of the things Steve said in this episode, I found myself repeating in other podcasts that came up on the Brenneman Blueprint, or other podcasts that I've gone on as a guest. If they have asked about tips, I mean, a lot of stuff around financing has come up. I mean, the debt markets have been really tough the last year, so that's been a hot topic. And so, I mean, people are looking for information on debt strategies and financing. And before we play the episode, just want to ask everybody, if you have not left a review yet, if you could please leave a review on whatever platform you're listening on. Really helps the podcast grow. Just doesn't take very long. Apple, you go on there, you click write a review, just say what you think, of the podcast, how it's helped out, or your favorite guest or favorite episode, and just 5 stars, press enter, be done, send it in. And same thing, Spotify, it's just a rating. You don't even need to write a review. And that helps immensely, though, with sort of telling Apple or Spotify like that this podcast is well received, and to push it out to other people that are searching in real estate or investing or whatever keywords this is associated with. So if you could do that, I'd really appreciate it. Podcast has grown a lot in the last year and a half, and want to really keep that growth going. So anything you can do to help with that, whether it's leaving a review or telling a friend or someone else that wants to get into real estate or that's in real estate about the podcast, I would definitely appreciate it. But without any further ado, we got the Steve Kundert Debt Masterclass on deck for you. Enjoy.
All right, with us today is Steve Kundert, Senior Vice President with CBRE's Debt and Structured Finance Group. I'm excited to bring him on because he's the most knowledgeable person I've come across when it comes to capitalizing real estate projects, specifically raising the debt. I suspect a lot of potential borrowers have heard of lenders like Fannie, Freddie, HUD, debt funds, life companies, CMBS, but maybe haven't spoken with someone who can originate all those types of loans. Steve Kundert can do all that and more, and we're going to pick his brain today. So please welcome someone I've done over 25 loans with, Steve Kundert.
Thank you, Drew. Happy to be here.
Great. Well, yeah, Senior Vice President with CBRE's Debt and Structured Finance Group. So what does someone with that kind of title actually do?
So what that means is I am a intermediary or a mortgage broker. A lot of people don't like to use the word broker, but that is in essence what I do. So I don't represent any capital myself. I place borrowers with third-party capital, be it some of your examples of Fannie, Freddie, HUD, life insurance companies, banks, CMBS, debt funds, really any provider of capital, in that if a client has a need for capital, they come to me and I go out ultimately and find the most appropriate source for that debt.
Great. Yeah, maybe before we get into the different like debt options out there, maybe why don't you tell like the viewers how you got into a position like this?
Sure. It's pretty straightforward. I think it's a little rare, but I've been doing this for my entire career. I've
nice.
always been a mortgage broker. This year marks my 20th year in the industry.
Nice.
I started my career with a boutique mortgage banking firm here in Chicago called Cohen Financial. Worked there until 2009, at which time me and my team went over to Grubb & Ellis, if you remember that name.
Yeah.
We started their mortgage banking platform because at that time, that was really when you started to have the integration of investment sales and debt. So it was the investment sales platform is not something that Cohen Financial had at that time. Grubb & Ellis had that, did not have debt. So it was a natural marriage. I was at Grubb for 3 years until they filed bankruptcy in 2012, at which time me and my partner were then recruited over to CBRE, where I've been ever since.
Nice. Well, great. Yeah, I think probably, I mean, the goal with today's podcast, we wanted to get into kind of the, major sources of capital. Like I mentioned, I've done over 25 loans with you. I mean,
Has it been that many?
Yeah.
You hear that number, it sounds.
I know. I counted them up before we started where I didn't remember the exact number already, but it was over 25. And then shout out to Jim Boza because he's been on helping with a lot of those Freddie SBL ones.
Absolutely.
Too. So, but yeah, I mean, probably let's give like just a general overview kind of on different debt options. So maybe on, let's say you have like a transitional property. So it's going to be a value add deal or a construction deal. I mean, what would like a potential borrower's, debt options be for something like that?
Yeah. So I'll actually preface everything by saying that I think the focus of the conversation will be multifamily.
Yeah.
That's not to say that I focus solely on multifamily, but that's how we're going to tailor this right now.
Great.
If you have any additional questions or want to talk about other property types, we can do that as well. But thinking about the apartment landscape, there's really two subsets of the market, what I will call institutional and private. It's really broken down by the size of the asset, and there's really no hard and fast line what delineates that institutional versus private, but there is a big difference in the type of lender. If you are looking at a private or sub-institutional property, in Chicago, that's typically sub 40 units, more likely probably 5 to 25 units, your 5 flats or your smaller courtyard buildings.
So what kind of, maybe just for like a broader audience, like what sort of dollar amounts were you talking about?
In terms of debt amounts, probably 1 million up to about 7.5 million.
Okay.
And 7.5 million is the number that I chose because that is the ceiling for which the small balance agency programs can lend to. Above that, you go into more of the conventional financing, and there's some nuances there that we can talk about a little bit later. But if you're looking at that private type of investment, the predominant source of that capital is still just your traditional bank. It's relationship driven. It's recourse, meaning that you are signing personally for that loan.
Yeah.
If something should go wrong with the loan, you're responsible for personal repayment, and that the bank can then go after your personal funds and everything else. The converse of that is non-recourse financing, which is the liability goes back to the entity only. The borrower has no direct repayment guarantee other than instances of fraud or misappropriation of funds, of that sort of thing. So the predominant source of capital for that private type investment is still banks. There's really not all that much I guess, nuance to the banking market. It's still pretty straightforward. The banks have looked the same and smelled the same for the most part for years and years. Where it is new in the market is all the other sources of capital, the non-bank sources of capital that are coming into the space. For transitional deals, that very much includes the emergence of debt funds. 5-10 years ago, debt funds, and I guess I should define that. Debt funds are typically private equity firms that have raised funds to go off and invest in real estate. They are short-term in nature, typically floating rate, non-recourse. In yesterday's world, to get a debt fund transaction sub $15 million, really sub $20 million in loan amount, it was a very small universe of lenders. Not very many people are doing that at all. Over those last 5-7 years, what we have seen is that market really explode to the point where you now have funds that are going off and doing loan amounts as low as $1 million, $2 million.
Oh, really?
Now, typically, because of the fee structure for those types of loans, it doesn't make sense. You're still better off going with a bank.
In fee structure, you're really talking about the origination costs.
The origination costs. So remember, these are funds. I mean, they are established to make a return for the mothership fund. And because of that, they need to make not only their percentage amount, but on smaller deals, a whole dollar amount as well. So if you have call it a $3 million loan, in order to get the same overall return as a $20 million loan, they have to not only price it higher, but they have to have a little bit more robust fee structure.
Oh,
so whereas a $20-25 million loan, it'd be typically maybe 3/4 of a point or a point going in, half a point, quarter point, maybe a waived fee going out, and generically a LIBOR-based spread of anywhere from 150 to 350 based on the profile of that deal. To make that whole dollar return and percentage return on the smaller loans, now you're looking at 1, maybe 2 points in, half a point, maybe 1 point out, and spreads that are typically higher.
Interesting. And then, I mean, let's say kind of maybe to back up then on a normal size debt fund loan. So something, let's say 10 million plus, like what would somebody be looking at for origination costs?
I think generically it's going to be 1.5. So one going in, half going out. And then in today's market, where we're seeing the biggest negotiation is on that exit fee. A lot of exit fees will come down to a quarter point, if not waived altogether. There are a handful of bridge to agency funds specifically that will waive the exit fee if you transition into a permanent product with that originating group. For example, CBRE has a fund that is designed to go from bridge into a CBRE, Fannie Mae, or Freddie Mac product. And if it does, then that exit fee is waived. We're seeing more and more in that in the market right now. But that's not necessarily specific to just those bridge to agency funds, because as the other truly independent debt funds work to compete against those bridge to agency, they're waiving that exit fee.
Yeah, so they're basically able to match that.
Exactly right.
And then one thing that's, unique to debt funds, I think, is there's not a lot of lenders that are looking for an exit fee. So maybe I'll just reiterate that, where that's when you say like a half point out or an exit fee, there's an additional, fee on, when you have your loan payoff.
That's correct.
Different because
Yes.
These are typically floating rate loans. So normally there won't be any kind of prepay, but they're building in some sort of a prepay penalty. I guess they shortened it, but they're building in an exit cost.
We'll call it an exit cost because there is a prepay penalty in that most of these loans, which are generically structured as 36-month terms, will have a minimum interest component. So if you do a 36-month term, it'll be effectively a yield maintenance through 12-18 months. So even if you pay off before then, you still have to pay 12-18 months of interest.
Yeah.
And that is, again, as these funds go, and it's really just math for them to go and
Right.
figure out the return that they need internally on a risk-adjusted return for that particular investment.
Yeah, it makes sense. And yeah, the debt fund market's really exploded. You as a lender, I'm sure every time you go on LinkedIn, there's a new announcement of a new debt fund.
It is. It's really quite remarkable how many hedge funds have established real estate debt funds, how many life companies have established debt funds. The statistic that I saw the other day was at this point of the year, the debt funds year to date have put out close to $30 billion of product. Now, in a vacuum, that number doesn't mean anything, but that is close to a 15-20% increase over last year, which if you now look at that's a pretty significant number.
Yeah, and I heard it's actually on a different podcast. People were talking with an intermediary, and they were acting like they're making very few agency loans. They're primarily financing multifamily, and it's in the South. So the cap rates are low. You need being at a full debt cover that these agencies require. That they're everyone's going debt fund because they're more potentially more flexible on the sizing going in. Maybe want to touch on that.
Absolutely. So to your point, especially with the the smile markets, East Coast, South, out to the West Coast, the cap rates that we're seeing, especially institutional properties trade, is from your exploration, it's in some cases it's sub 3% cap rates, unless you're a pension fund with a cost of capital of 100 basis points. Typically that's not going to be a long-term hold for everyone.
Right.
So when you're buying these assets, there is some upside, whether it be a renovation plan, whether it be an opportunistic growth in rent, whatever the case may be, there's value creation. So to go off and do a permanent loan today, you're trapping a lot of that equity. Most private entrepreneurial investors are looking to lever up reasonably to as much as possible. So if you're looking to lever up as much as possible because you're buying that at such a low cap, inherently the debt cover is going to be low. And if you're going to an agency product where you are sizing to a box, both LTV and debt service coverage, when you fit that box for coverage of the 120 or 125, that's going to push down leverage to 50%.
Yeah.
If not lower, and you're buying on a 3 cap. So that's now a big, not only is it a big check to write, but once you go and create your value, disproportionate, your debt is going to be now 35-40%.
Right.
So that is why people are using the debt funds, because they have the opportunity to go in upwards of a 70, 75, 80% loan to cost, and have the ability to structure an interest reserve so that you can get around that coverage hurdle, and now give the investor time to go through, accomplish their business plan, and then have your capital event on the exit, whether it be a sale or refinance.
Yeah, it's an important thing. I mean, there needs to be some sort of value creation plan where you can't get in these low cap rate markets, a 75, 80% LTV debt fund loan if there's no, plan to, create value, drive the NOI up.
That's exactly right. So if you're looking at how the lender will be sizing, the debt fund lender will be sizing that loan going in, it will be based largely on the exit, because they want to make sure that it is a financeable deal. Now, that being said, if it is a sale, you don't necessarily need to size to just a refinance exit. It is more prevalent, but using just generic numbers, a 7% exit debt yield is really the benchmark of what we're seeing in the market right now. That is where, if you back into where Fannie Mae, Freddie Mac, CMBS market to a certain degree is looking at their loans today, that's what they kind of back into.
Yeah, and they're looking at the stabilized debt yield though.
That'll be a stabilized debt yield. That'll be a debt yield today. So if you were to do a loan today, that is what your debt yield will be. So a debt fund, which is looking at what the cash flow will look like tomorrow after you've done your work, they want to size to that exit.
Yeah, so if it's like a 3-year business plan, 3-year debt fund loan, they're trying to be at a 7 debt yield on your year 3.
Correct.
Pro forma. And then debt yield, NOI divided by loan amount, right? So
easy
we
math.
to make sure everybody's got that. Anything else worth touching on debt funds on?
Just say that in addition to coming down in overall size, what we are seeing in the market is the opportunity to potentially push up leverage as well. Earlier this year, I closed an 86% loan to cost deal that was structured as an AB internally, but it was seamless to the borrower.
Maybe let's define with AB.
When you're looking at a senior loan, we'll call that the A piece. So senior loan will go up to typically 75%, maybe 80%. Everything above that, we can call it mezz, you can call it a B piece, whatever you want to call it. That'll go up from 75 to usually around 90% is where that mezz will be, 85-90%. Above that, now you're talking about equity.
Yeah.
So this particular investment, which was a multifamily complex in suburban Chicago, the sponsor was looking for either an equity investor or mezz to bring them up higher. Well, you bring in equity, that's a whole new ballgame in terms of your cost of capital, in terms of the approval rights that those investors have in your business plan. So what we were able to structure for this particular client was a single point of contact loan that went up to 86% of cost. Again, seamless to them. So when it comes time to write their mortgage check, it's one check. They're not paying lender over here, lender over here, equity investor over here. It's one payment. And that they were able to go off, get 86% of cost that included renovation dollars to accomplish their business plan. And the cost of capital was only slightly higher than what it would have been had you gone up to just 75%. Because if you look at that blended cost of capital, whatever that 75 to the 86% was priced, I don't have transparency into that, but you look at all in, it was a 4% rate.
Nice.
If you consider generic cost of equity is 10, 12, 15%.
Yeah.
Look at that blended cost of capital. I mean, that really juices the returns.
Yeah, especially that leverage. And then, I mean, you have, two different lenders, that both get what they want, where you have a more secure, A piece and it's getting a lower rate, and then the B piece are getting a higher rate. So then typically who would be in that B piece? That's more like a different debt fund, or what would be?
There are funds that have been raised specifically to buy B piece, both on in the CLO market as well as the CMBS market. CLO typically being floating rate, CMBS more of the fixed rate, longer term. But there are also single point of contact firms that do both.
Oh, okay.
And that is really where you get the most efficiency when you try to pursue that type of product.
Okay, well, I think we probably covered debt funds enough. Why don't we jump back to bank financing? What would someone be looking at for origination costs on a bank loan today?
So banks will typically take a 0.5 point to a point origination fee, usually not an exit fee. Now, as we've touched on before, that type of money is also usually a little bit more conservative. But that being said, there are inherently more flexible options that you can price in with a bank, whether that be a future funding or accommodation if you're looking to buy a deal in phases, whatever the case may be. But again, that's recourse money. So that there are options, there are advantages and disadvantages of going with a bank. That flexibility, that ease of execution is one of the main pros. The cons being that it can be a little bit more conservative.
Yeah, definitely. What would, one thing that comes to mind comparing a bank and debt fund is the, like loan covenants. So, like a lot of the bank loans that we've done, we actually couldn't get the debt service coverage covenants out of them. I mean, we were picking the bank, I'd say primarily based on rate and like with flexibility on other stuff than that. So then like that always comes to mind because I have some bank loans where we have a debt service coverage covenant. Maybe want to, touch on that.
Yeah, that's a great question. Great question. So with banks, almost 100% of bank lending will have a debt service covenant involved. A debt service covenant, for those who may not be familiar with that term, is that it is an ongoing requirement for the property to maintain a minimum amount of cash flow. Usually, even though the loan might be sized, and this goes for both transitional and permanent loans, even though the loan might be sized going into a 120, 125 cover, there'll be an ongoing covenant that it needs to maintain a 105, 110, somewhere in there. That means for every dollar of mortgage payment, you need to have $1.10 of cash flow. If you fall below that, it is an event of default. And that's a pretty heavy hammer that bank can wield. So what we have done on the advisory side is we are working with the bank, with the borrower as we go off and help to negotiate those loan docs to, one, make sure that we have sufficient remedy time. Once you hit a 104 cover on a 105 covenant, we want to make sure that the lender's not going to be in your driveway with his hand out looking for those keys. On top of the remedy time, in the event that you don't remedy the cash flow in a certain amount of time, whether it be 6 months, whatever it is, you make sure that the remedy beyond that is not value driven. So the distinction there is the remedy on a resizing for value was that the bank could require a capital call to downsize the loan such that the in-place cash flow now maintains whatever that covenant is back to the 105 cover. So that can be a pretty big check to write. The alternative to that, and this is what we negotiate in our loan docs for our clients, is more of an income covenant. So that rather than adjusting the loan itself, there is a posting of cash to bridge that delta between in-place cash flow and whatever that covenant might be. So if you are, again, using our 105 cover, if you have a dollar of cash flow and your debt service is at 105 cover, rather than downsize the loan, which could be a 20% check, you're giving a nickel to the lender to hold into escrow until such time as the cash flow gets back above 105 for a certain period of time, typically 2 quarters.
And what you're negotiating is where you're posting the difference between the 105 debt cover and the actual cash flow.
That's exactly right.
Okay. And then again, debt cover, I mean, the math on that, just to define what we're talking about. I mean, that's the NOI divided by your loan payment, principal and interest. So, actually, I guess on these IO like debt fund loans, I mean, are they sizing it with the principal and interest payment, or are they just keeping it IO the whole time, interest only?
The sizing for debt cover for debt funds is that's not a primary metric. Okay. When they do look at that, because they will look at that, it's just not a primary metric, they'll be taking it off of that IO constant, because more often than not, a transitional debt fund deal will be interest only through the primary term. There might be some amortization in the extension periods, but during that primary term, it's going to be interest only, and that is what they'll be looking at.
Okay, interesting. Well, that's another debt fund bank difference, because no bank would size off of IO.
That's exactly right.
Yeah, I think on those deals where we had the debt service cover requirements, we had 2 years where we could fund cash. I guess it wasn't clear where it's going. Thinking about it now, I'm sure it is in the docs, but not from my memory. To fund the difference, I guess they would just hold it in a different.
It's typically held in escrow. It'll be held as additional collateral, and for any of these negotiation points, you have to remember what is the perspective of the lender. Their perspective is typically, well, if I own this property, what do I need? What do I want?
Yeah.
To make sure that I'm not writing a check myself, because all these lenders are not in the business of owning real estate. They don't want to own real estate. So they want to make sure that in the event they do have to take back those keys, that there is sufficient capital, sufficient structure in the loan to make sure that if it comes to that, they can now access that escrow account. They don't have to write a check themselves.
Yeah, it makes sense. And I mean, I think that, for me as a borrower, I always kind of have the debt service coverage thing in the back of my mind, like which deals have it, which don't. Mm-hmm. And we haven't got to the, Fannie and Freddie stuff yet, but that's one thing that I've just loved. Like I sleep comfortably at night, and I, owe way over $100 million of money on deals, but it's pretty much all non-recourse with no debt service coverage covenants. So hard to get, jammed up on those kind of loans. Cause I've seen, other borrowers just kind of from afar where maybe they have a retail portfolio, and then you lose some big tenants. Then this is not debt related, but then you might have a co-tenancy clause, which means if you lose a certain tenant, then the other tenants can pay less rent, and now you drop below your debt service coverage covenant, and then you need to be paying down your loan, where there's a cascade of, horribles basically. So.
And on the retail side, that is why co-tenancy clauses there's so much attention to them because of that very reason. Now on the multifamily side, you still get into that situation sometimes as well. But I will say that in evaluating the transactions that you have, you underwrite better than most of my clients. So I would I don't blame you for sleeping well at night with the amount of time you put into your underwriting.
Thanks. Yeah. And then I think maybe one more transitional source that I had thought of is probably not typically thought of, but if you're doing and maybe the standard Fannie Freddie programs have this, but that I've done this a few times on deals where we bought them. They were small balance loan sizes, below $7.5 million if you're in a large market. Doing the Freddie Mac SBL program with the 3-1-0-0-0 prepay. So the prepay structure on that, it's 3% year one, and then drops to only 1% and 0% thereafter. I mean, that worked out great for us on deals where we didn't need additional funding. It wasn't like a huge rehab. It was going to just be buy it. The rents were way below market, raise the rents, or do a rehab amount that we could just fund out of cash. It wasn't going to be worth doing draws and stuff. That's something that we, maybe I'll throw in the mix that worked great for us. If someone's got, a deal that size is really cost effective and simple that first year, as we did the 5-year option, it's interest only. It worked out great.
Yeah, that is actually a good point and a great program that is, while not necessarily the intent of that product, it has been used, to your point, for that very purpose, where you have a 3% year one prepay, 1% year two, and then open at par for the last 3 years. And the increased cost of capital for that product over their base pricing is only 30 basis points, which it's hard to say only 30 basis points, but if you look at the alternative of a debt fund, when you're pricing entrance fees and exit fees, I mean, that is very cost-effective capital. It does allow, if you're looking to pay for those renovations out of cash flow, that does allow a nice option to lock in a very attractively priced product. Ease of execution is pretty high, relative to debt funds, because it is streamlined on being the SBL program. And I will say that if the intent is to pay out of cash flow, there are programs on the conventional side, conventional being north of $7.5 million, where you can effectively do the same program. So any Fannie Mae and Freddie Mac product of longer term does have a modification rehab program. Whereas if your intent is to invest a minimum amount per unit in renovations, it varies a little bit between the agencies, but we'll just say it's about $10,000 per unit. You can check the box that it's a mod rehab, go off and close a conventional, typical fixed rate product. You have 12 months to complete the work out of cash flow. And once you do, you can then go back for a supplemental. Now, typically a supplemental, whereas any agency product has the ability to go and pull out additional cash with an increase in NOI, but there's a premium associated with that.
Yet the supplemental, the rate's higher.
It's much higher. It's the premium on that is about 50 basis points. Now, with the mod rehab program, when you check that box going in that, yes, this is mod rehab, as long as you fulfilled the requirements for that program, being that it's a minimum amount per unit. Minimum amount per unit overall was actually invested in the units, not in the community.
Okay.
Then you can go and get that supplemental without that premium charge. Now, you're still subject to then market interest rates, so whatever that might be, up or down versus where you're initially locked, but you don't have that premium.
Okay,
so that is also a cost-effective way to go off, if you're comfortable and able to pay for those renovations out of cash flow, to go and really lock in today's interest rates while still doing the rehab that you're trying to do on the product.
Yep. And then and your initial funding, that's locked the whole time. That's not resetting.
Correct.
You're done.
So now you're blending the overall capital stack for that debt of whatever you lock on the first day of closing. And that supplemental piece is then locked at that whatever the market rate is at that time.
Great. Yeah. And then, I mean, you're saying you're doing the renovations out of cash flow, but someone could just also raise the money or just fund it sort of at closing with cash, right?
Yeah, out of cash flow is more of a catch-all term.
Yeah.
The point is that it cannot be capitalized through the loan.
Yeah.
So it's not like a debt fund that would give you future funding to go effectuate your business plan. It has to be paid outside of the loan.
Yeah, makes sense. And then on let's say then this probably last thing, since we touched on the debt service coverage covenants. So I mean, like Freddie SBL for the transitional stuff we talked about, that doesn't have it as a loan default. Then debt funds, do they typically have that? I would assume not, because we're transitional and we're sizing to a 7 debt yield at the end.
They do not. There will be close attention paid to the monthly cash flows. And if there is a perceived lack of cash flow or perceived below break-even cash flow, that's when you structure an interest reserve. And that'll be built into the total project cost at closing. You can capitalize that at the same LTV or LTC as the rest of the loan, and that'll be held by the lender. So in the event that you do fall short, you can now, instead of having to write a check, you pull money out of your interest reserve over here and you pay Mr. Lender over here.
Yeah. Then maybe let's get a little bit more into what an interest reserve is, because then that, you can fund these deals that are where you're going to do your value add, but the cash flow is actually going to be negative most likely during this period. And then you want to get into that.
Yeah. So the purest example is, let's say you buy a vacant building. You have a developer that sells a building at C of O, says, I don't want to deal with the lease up. I'll sell it to you. I'll leave some meat on the bone. You, Mr. Investor, can do it yourself. Well, now Mr. Investor says, okay, yes, I want to buy this. I want to lever it up as much as possible. We have no cash flow. Now, these are non-recourse loans, right? So inherently, the lender is looking for the debt service to come strictly from the property itself. While as a bank might look at the investor to be able to write a check themselves, a non-recourse lender, a debt fund in this case, will be looking for cash flow from the property. Well, there is none. So what do? We artificially create it by structuring in that interest reserve. So that is a separate pocket of money that is funded at close, put into an account controlled by the lender. And then up until that point where you have break-even coverage on your cash flow, you pull your mortgage payments from that interest reserve.
Yeah, it makes sense. Where on a recourse loan, maybe they're looking to the borrower, like they'll fund it. But on this, it's non-recourse. They want to have that money sitting there knowing the payment's going to get made.
Exactly. So if they were to have to take back the keys, they now have, just like the borrower does, they have this pocket of money from which they can pay their own debt service.
Nice. Great. And then the maybe I think that's plenty then on the transitional deals, so then let's say permanent capital. So we have, you have a stabilized multifamily deal. We can touch on commercial too, because there's other products that are probably just more prevalent there, like CMBS and whatnot. But let's say, so then permanent capital, like what are the options for that?
For higher leverage being north of 65%, it's still the agencies. It's Fannie Mae and it's Freddie Mac. They continue to be the dominant market share leaders for multifamily. And that is more so than CMBS, which, because of the way the rating agencies have to size the cash flow, they're never competitive. More so than life companies, because of the way that life companies need to size their loans, anything really north of 65%, it won't fit their box. The debt yield just isn't there. The loan per unit just is too high. It's not what life companies are set up to do. Now, if you back down to lower leverage, life companies are going to be more price competitive, but typically the investors with whom I'm working are looking for more leverage. Maybe not necessarily last dollar, but not 50%.
Yeah.
So that leaves the agencies. And depending on the profile of the deal, Fannie Mae and Freddie Mac, the pendulum kind of swings back and forth as far as who is more competitive at any given time. They look, smell, and feel very similar. There are some nuances between the two, but generically speaking, they can both go up to 75%, 80% if the cash flow is there, and your cost of capital in today's world is mid threes, with interest only available on the front end. Now, there are again some nuances to borrowing through either of those agencies, but much less arduous than CMBS. So it's really no surprise the attractiveness of those programs, and the floodgates, so to speak, are remaining open. So the announcement for the 2022 allocations just came out, and both Fannie Mae and Freddie Mac have both been allocated $78 billion to lend for 2022. That's an $8 billion per lender increase over 2021 numbers, which is 11% increase. Yeah. So that just shows you that there was a lot of talk over the past 2 years about the reconfiguration of the agencies as they are today. But from what we are hearing right now, it's going to be business as usual, and really more business as usual as they continue to push out those high cap allocations. Within that $78 billion, there is a mandate to continue to lend on affordable properties. The mandate is 50% of that $78 billion is targeted for affordable properties, and 25% of that $78 billion is mandated for AMIs less than 60%. So that's your average median income for the area. At its core, the intent of Fannie Mae and Freddie Mac is to promote affordable housing. And so by putting in those mandates, that is helping to make sure that, in this case, at least 50% of that money goes to promoting that affordability in U.S. housing stock. Now, that's not to say they won't lend on luxury properties with a $4 or $5 a foot rent. They will. It's just 50% of that does have to go to affordable product.
Yeah, and one thing that would be interesting for people to hear, like how they're viewing affordable. It's not just Section 8, Section 42 housing. It's just at a certain. It could be market rate, but just it needs to be at a certain rent level for the area.
That's correct. So you look at the area income, and you base the affordability off of that. So when you originate a Fannie Mae loan, let's say, you do go in and put together an affordability model. The affordability model is based on the census tract for that area. So you might have a property in Lincoln Park that might have a $2.50 rent that would still qualify based on the immediate area as affordable, technically. Now, you take that $2.50 rent, you put that out in a rural area. Obviously, that is far and away 2.5 times what the market bears, so it wouldn't be affordable out there. But just because if they look at the surrounding area, it would be classified as affordable.
Yeah, and Fannie and Freddie, or at least I think Fannie, they had a lot of rent data going back. And actually, one thing we bought, I think we bought it or it was free for our AI machine learning model. That was one of our inputs, like what they had over time, like the rents for an area, because we ended up getting it our model down to the zip code for rent predictions. But that was one of the things, because they had a lot of good rent data in there. So it was interesting, because then there is some place to look up what the rents are if you want to know if it's affordable or not based on their standards. And I think that might be like the data set we bought. Actually, I'm not sure.
Yeah, and that geographic distinction is important as you are looking at putting together a loan, because the pricing benefit for affordable versus not, especially as you get further into the year and those allocations reach closer and closer to the cap, they can be pretty substantial. They can be every bit of 30, 40 basis points.
Yeah, and then has Fannie and Freddie, have they been hitting their caps in recent years, or?
They have been. So 2 years ago or a year and a half ago, there was some concern because they had reached their cap early, and so when they reached the cap early, pricing gapped out tremendously. The regulatory agencies that saw that realized what that was doing to the overall greater market, and they increased the cap for the rest of the year. And I think they've been managing that a little bit more effectively going forward, because if you look at the 2022 caps, increasing it by that $8 billion, that should provide enough dry powder for the market to go off and do what they need to do.
Yeah. Okay, nice. And then I don't think we've touched on sort of there's a lot of different options with, I mean, especially in the SBL program that I guess I would know best, but so for Freddie, small balance, a lot of different prepay options, a lot of different things you can pick from interest only. I mean, maybe since for the permanent loans, like if someone's borrowing, say Freddie small balance, we'll just start small, work our way up. Freddie SBL, like what are all the options out there?
So with Freddie SBL, the small balance loan, it is designed to be an efficient source of capital for small properties. So it's minimum of 5 units, minimum of $1 million, $1.1 million currently, but below $7.5 million. The intent is to create as much efficiencies as possible to streamline the fee structure and the closing process for those smaller properties. So if you look at a conventional Freddie or Fannie, there are fees associated with closing, not an exit fee or going in fee or anything like that, but you just look at whether it's the legal fees or the title review fees or XYZ, whatever the case may be. Some of them are fixed amounts. So when you start looking at some of those fixed amounts relative to a small loan balance, you could have 3, 4, 5 points of closing fees. Well, on a $1.5 million purchase, that's a big chunk that it really puts everything out of whack. So,
but you were saying if you're putting a conventional loan on it,
a conventional loan on a smaller property.
Okay. Yeah, so then that's why they roll out this program.
So the Freddie Mac SBL is designed to be streamlined. There's no negotiation of loan docs, very little negotiation of loan docs, and the process is very cookie cutter. Now, I think that Freddie Mac, to their credit, has realized that cookie cutter doesn't work for everyone. You need options. So what they have done is within the confines of that program, they have given options. You 5, 7, 10-year financing. You can do a fixed or a hybrid. A fixed meaning that there is a balloon due of the outstanding balance upon maturity. A hybrid meaning that upon maturity, that loan converts to a floating rate, whereas you have a 1% exit to get out, but there's no covenant on a refi. So if you're worried about performance of the property or the market going the wrong direction around the same time as you're refinancing, then you could utilize that hybrid option. They have multiple options for prepayment. The base is a yield maintenance. They have the next step is a standard prepay, which on a 10-year is a 5544332211.
And these numbers are the prepay
That
per
is
year.
yes.
So
So 5% of the outstanding balance in year 1, 5% in year 2, 4% in year 3, et cetera, et cetera. On a 7-year, it's 5544221, and a 5-year, it's 54321. They have, for an increased cost, you can do a soft step down of a 32111 for a 5-year, a 3322111 for a 7-year, and a 333222111 for a 10-year. And then there's the most flexible, which you touched on earlier, only available on the 5-year product, which is the 31000. Now, each of those different tiers of prepayment come at a cost. The yield maintenance being the less expensive, the 31000 being the most expensive as an add-on to your base coupon. But if you look at it as an insurance policy, not knowing what your exit might be, or rather when your exit might be, in a lot of cases, it is worth going with one of those more flexible prepays.
Yeah.
Because a yield maintenance penalty could be a very, very onerous number. If you look, just do the basic math on a 10-year loan, and you look to prepay in year 1, that prepayment penalty could be every bit of 25, 30 points.
Yeah.
So now all of a sudden, if somebody comes in and says, Drew, I love your property, I'm going to give you a 2 cap. It's like, all right, here, it's all yours.
Yeah.
But now all of a sudden you have a 30-point penalty. Well,
Right.
that hurts. So that's why now that you're expecting that investor to come in and say that, but at the same
That
time,
stuff happens.
you never know.
Or you have a
And that's the insurance policy. So that's the flexibility on the prepay. The yield on the interest only, there is full term interest only available up to 65% leverage. There's several years available at higher leverage amounts. Depending on ultimately how high you push that leverage will dictate what is available for you, with each year of interest only, again, adding basis points to the spread. That, again, just comes down to math. Less so of an insurance policy, but more as math. What is the return that I'm targeting? Does that front-end interest only really help with the returns? Am I doing renovations funded out of cash flow? I know that in year 3, it's going to be a higher rent, so I can afford to pay amortization in year 3. But years 1 and 2, I want that IO constant. So these are all different menu options that a borrower has. And what we do is we sit down, and we've had this conversation before. When you sit down with the borrower, you find out, what is your business plan? What do you think your business plan is? What do you think that your business plan isn't? And get a feel for what really is the investment strategy for that asset. Typically, you want to match up the term with your likely investment period. But beyond that, that's now when you have the prepayment flexibility you can build in on top of that. And if you know you're going to be a 3-year holder, you don't want a 10-year loan.
Right.
If you know you're going to be a 10-year holder, you don't want a 3-year loan, unless you know something about the market that the rest of us don't.
Right.
So I mean, there are a lot of options, and it can seem a little daunting to wade through all that. But that's where we come into play. It's just to have that conversation, to know the questions to ask, and to know what can be done with that loan to tailor it to what we're hearing from the client.
Yeah, it's a great program. I mean, that's, I think, what I've done the most loans just by like number is Freddie SPL. And it's totally customizable. You just look at sort of the sheet or whatever, if you will, and go, okay, this loan, I think will be in it for 5 years. Let's Just in, we don't need to refi in the meantime. So yeah, why pay more interest and do a 10-year? I'll do the 5-year, and then, but you never know. Maybe we want to sell earlier, so let's not do a yield maintenance. We'll pick one of the step downs. Yeah, because I've done a lot of different loans within that. Where yeah, if you know you're going to add a lot of value and you want to put a new loan on the property, yeah, then you go with the most flexible. Or if you're not, it's a longer term hold, then you go with like a 10-year step down.
Right.
So yeah, that's what we've done the most loans with on our side. And yeah, one thing that I've learned, and almost maybe through you, and then also just that program too, because it's like lays it out and you have to decide, because the difference in rate, I mean, you would know the exact add-ons, but like if you did the 5-year, I think the way they treat it is it's like the yield maintenance, you take 20 bips off the base rate. So then if you do the most flexible 3100 prepay, you're adding 30 basis points on
To the base rate, correct?
Yeah, so then it's a 0.5% difference, so you got to really think about your plan, because if you're just, well, no, I just want the lowest rate, I'm keeping this thing for 5 years, I don't, that's what I'm focused on. Like you can essentially, you'd be a 0.5% lower than if the person who wanted the most flexible. So so that's something I ended up thinking a lot about. And then I really started rethinking about how I look at the loans. Or I'm looking sort of from the sort of what does the end look like, and just working backwards, where if you're, and actually last year, three of the deals we bought, we assumed the loans from people who did an agency yield maintenance deal, and their business plan wasn't to keep it for like 10 years.
Right.
They're all developers. And so but that's just what they did. I would assume they were just looking for max proceeds to keep it in one instance in the full term interest only bucket. And so then when they wanted to sell, then they, the buyer pool is probably limited.
Right.
And then that, it's a great opportunity for us, because we're able to assume those loans. Can do the paperwork and all the brain damage on that, and
But not good for them.
Yeah, I mean, but so I've learned that, just kind of seeing what other people are doing, and then looking at my own deals, going, okay, if I'm going to sell this thing in 2 years, well, yeah, let's just put like a 3-year loan on it with flexible prepay. Don't do a 10-year fixed yield maintenance. You're gonna pay 10% to get out, or have to sell it to somebody who's going to assume it.
And I'll say that that analysis, that conversation, that's what I do. That's frankly where I add the value. To go off and actually access these various programs, especially SBL, is not hard. I mean, there's a number of lenders like CBRE in the market where you can pick up the phone, you can call them, and they'll say, yeah, here's your small balance quote. But what that doesn't have is that discussion, that analysis, because frankly, that lender, they're looking to get out money. My job as an intermediary is to work with the client and bring them to the lender and have that conversation and make sure that I mean, not everyone is going through the same thought process, that you are, which is unfortunate, because a lot of times some of those investors can get taken advantage of by that lender who's just really just looking to push paper and close that loan.
Yeah.
To be able to know, this is what you should be thinking of. These are the pressure points. Well, what about this? Should you consider this? I mean, those conversations are really, really where I add the value.
Yeah. One thing you do great at is the advisory piece, where being able to look at the business plan and the debt options, where like you can access all the types of debt and see what others are doing, and then are able to give great advice. So that's one thing I've always appreciated.
No, I appreciate you saying that.
Yeah. And then I think, so then that's, probably, and, I guess Fannie, they also have a small balance program. It has seemed like for, my, point where I've been using the SPL program, I think all but maybe 2 of the loans have been Freddie. So then, I mean, Fannie, it's more or less a similar program. It's just kind of just whatever, they kind of flip flop on who's more competitive.
It's a very similar program. It's actually it was the first small balance program, way back when. It was, called a 3 max, 5 max, because it was maximum 3 million, and 5 million for the urban areas. And then it went away, then it came back again. And right now, and I do mean right now, they are priced much wider than Freddie Mac. Now that pendulum swings back and forth as far as which one is more competitive. In the near past, the Freddie Mac program has been more competitive. So that's where most of the business does go. Now there are, again, nuances where you might want to go with Fannie Mae versus Freddie Mac. and pay that extra. But those are very rare exceptions. So as it stands right now, Freddie Mac is really the dominant small balance lender, although that could change next week if Fannie Mae were to decide, okay, we want to better our cost of capital and put out more money in that segment, because that's really what it is. It's managing, again, that allocation by raising and lowering the price of that money.
So then is Fannie just kind of more focused on doing the conventional program then, or what's the
Currently they are, yes.
Okay. Then yeah, maybe let's get into that then. So we touched on the SBL options, and if you have a loan that's over 5 million in some markets or 7.5 in the, I just call it the major markets. Is that the right term? Or
main markets.
In the main markets. I mean, so then what does that look like?
So it's going to, in terms of the sizing metrics, it's going to be very similar. It's going to be a max 80% on acquisition, max 75% on a cash out refi, sized down to a minimum 125 cover, with interest only available up to 75%. Below 70%, you bring in the possibility of full-term interest only. Below 65%, you bring in the possibility of full-term interest only and an entity carve-out. And I'd say the biggest drawback to Fannie Mae financing, besides the closing process, which can be a little arduous, is that for the most part, in terms of cost-effective programs, their prepayment structure is strictly yield maintenance. Now, if you look at a 10-year loan, it's yield maintenance through 9.5, then 1% for 3 months, then par at 3 months. They do have options where on a 10-year loan, you could do 7 years of yield maintenance and then 1%. But and actually beyond that, you could tailor it even further with yield maintenance through whatever specified period you want, then 1%. But that add-on and pricing gets expensive very quickly.
Interesting.
So what we're seeing for the most part is yield maintenance all the way through 9.5, an occasional 7-year yield maintenance, but for the most part, all the way through. Now, the way to look at that is almost like a CMBS loan, in that you're only going to put in a Fannie Mae loan if you know you're not going to sell it in the near term. Now, they do have shorter durations. They have 5 and 7 year money. 5-year money isn't all that competitive right now, again, with the way it's pricing. But on a 10-year, it is still very, very aggressive capital. And if you are a long-term holder, then it is definitely worth consideration to pursue that program, because of the way that you can structure in that interest only on top of an already aggressive pricing.
Yeah. And then really, so then the fixed rate, you're thinking it's, if you're the borrower going in, it's going to be yield maintenance.
Correct.
The agency. And then they do have floating rate programs out there.
They do have floating rate programs. In terms of floating rate, Freddie Mac's program is more competitive than Fannie Mae. Fannie Mae's program is designed really more for larger institutional, and I say larger, I mean 75 million plus, to make it worth everyone's time. Whereas there are more floating rate options for Freddie Mac.
Yeah, I've seen just hearing about a lot of borrowers in like the really low cap rate kind of markets, the Phoenixes, the Texas and Florida, where they, like, it seems like they're either doing a debt fund or they're going with the floating rate conventional through one of the agencies. So I guess
you need you need that IO constant to make positive leverage on the asset. I mean, when you're buying at a 3.5 cap, if you're over 3.5 on your coupon,
right,
you're negative leverage.
Yeah, it's not helping any. So then, okay, for multifamily, I mean, other sort of permanent sources. I mean, you hear, I see a lot of, conversation of HUD loans, where the initial rate is exciting. They leave out the mortgage insurance premium added on, but they, and the fact that it costs an arm and a leg to close it, they, leave that out when they put the loan on for 2.5. But maybe let's see, the 223F program, that's the stabilized one?
The 223F is for acquisitions or refinances, and that is it can go up to 85% of value with it's a 35-year self-amortizing loan with prepayment flexibility after 10. So it's really look at it as a 10-35. So you have a 35-year AM.
What's the prepay structure? So yield maintenance through year 10, and then what's
it's a fixed decline through year 10 and then open after that.
Oh, okay. So fixed decline, just like a step down.
Correct.
Some sort. Okay, that's more flexible than I would have thought.
It is. So the product itself is attractive. And the leverage going in, the cost of capital, to your point, you're even with the MIP, you're hovering right around 3%. The leverage that you can achieve. The issue is closing process is long.
Yeah.
I mean, for the 223, you're looking at every bit of 6 to 9, sometimes more months, and there are restrictions on what you can do after close in terms of the number of distributions of cash per year, in terms of your reporting requirements, the auditing requirements. So to have even a middle market borrower use that program, it usually winds up not being all that efficient, because not that you need a separate department to manage that loan, but you almost do. You need someone who's going to be, you need to have books that are kept properly, that are up to the requirements of HUD. And again, the one distribution of cash flow per year, that is not often what middle market investors are looking for when they invest in real estate.
That's an interesting restriction.
Yes,
I didn't know about that.
And then the other program that you mentioned that is for construction or heavy rehab is the 221D4, which also goes up to 85% of value. That has a 40-year amortization. Again, the cost of capital is pretty strong. It's actually cheaper than the F right now, but it's the same scenario in terms of what it looks like during that stabilized period. And what I have found in my experience is that for most properties, especially in Chicago proper, because of the constraints that they have on cost, both on a statutory mortgage limit, meaning they can only lend so much per unit type, as well as the minimum prevailing wage requirements for your contractors. Once you put in those minimum prevailing wage into the cost budget, it inflates it too high.
Yep.
I was sizing up a development loan up in Uptown for an asset, and I forget the exact number, but when they came back with the prevailing wage, they would have had to pay their drywallers something like $80 an hour.
Yeah.
And the contractor said, well, that's great. Even if I give you a quote at this, I can't pay my guys $80 an hour, because now the next job, they're going to expect that again. And so between what it does to the cost structure going in and the willingness of a GC to pay those wages, it winds up scuttling the deal.
Yeah, I was at a place I was working. This would be 2009, so not a lot of options for capital. We were looking at a apartment development deal in Texas, in the Dallas area, and we were going towards that because the Davis-Bacon wages didn't really move the needle that much there. And then basically the only game in town. And then, I mean, one plus with both the HUD programs that we're talking about, it's non-recourse the whole time. Even with the construction one, you obviously have to complete the project and do other requirements, but at least the loan, it's non-recourse. And that's, at that time, this is the only option for that. And even still, until like the emergence of debt funds, it would have been pretty rare to have a non-recourse construction loan.
Right.
So
it does make sense typically in the southern markets, in the southeast markets, but for whatever reason, as you go north into the Midwest, those prevailing wages start to get high in a hurry, and they're far and away higher than union wages.
Oh, interesting. Okay, yeah, wasn't aware of that. So then, I think that's plenty on maybe on the agency. So then it'd be pretty uncommon for multifamily deal, but let's just touch on CMBS. I mean, it could be people looking at other product types.
So the two types of two additional sources of capital that we haven't talked about is life companies and CMBS. CMBS, which is securitized borrowing. So your lender makes the loan and then packages it up into a bond, sells it off into the secondary market. It's actually very similar to what Freddie Mac is doing. So Freddie Mac now is securitizing almost 100% of their loans. CMBS, if you look at the traditional CMBS lenders, they are subject to the rating agencies. And the rating agencies are the ones that really drive what is that cost of capital. Does it fit into this box, or this box? Well, when the rating agencies look at the cash flow, they have to do certain things to the underwriting. Just like Fannie Mae has to take they'll look at a trailing 3 for their income, trailing 12 for other income. They'll take in-place expenses and inflate it by 3%. Very formulaic underwriting.
Yeah.
The rating agencies also have a very formulaic underwriting, but for whatever reason, that formula is much more strict in that they are taking, just for example, in the Chicago market, whereas a 3-5% vacancy tops, I think the rating agency requirement is they have to underwrite it to a 13 or 14%
To size the loan.
to size the loan, on top of the inflation of expenses and below the line reserves off of which they then base their cash flow. So when you actually get down to a bottom line cash flow number, not only does it push down the proceeds, but your cost of capital is usually, if not on top of, in excess of where the agencies are.
Yeah.
So that's why you're just not seeing a ton of CMBS loans in that market. Now, that being said, where they do come into play is potentially some secondary or tertiary markets that the agencies will not go to for whatever reason. Student product, which the agencies, again, have pretty strict regulations on. Some of the, I guess, the non-traditional multifamily, that is where, to the extent that you are seeing CMBS in that market, that's where that's being utilized. It's really those markets where the agencies can't lend, or that those products the agencies can't lend.
Yeah.
So generically, again, you can get term IO at 65, 68%. So that is good, but 68% of what is the question? Right. So, I mean, if you're now comparing proceeds apples to apples, that CMBS quotes can be much lower.
Yeah. I mean, then they're going to lose to the agency every time in terms of competition on loan sizing. And then, then they're left with the commercial product types then to lend on. Where if you're in office or something where that's already a 13% vacancy, that's not as big
exactly right.
Doesn't move the needle as much. What about life cos? Why don't we?
So life companies are competitive, as you mentioned earlier, on lower leverage. Again, because of the way that they size. So I recently took a 16-unit deal in the uptown market. Good, clean deal. I mean, right down the fairway in terms of cash flow occupancy, good history and everything. You go to the equity markets today, and that's a 5 cap.
Yeah.
If not below, right? The life companies, they have to size to a minimum, size to a minimum cap rate. And it's not set like the rating agencies. Each lender is going to be a little bit different. But for example, this particular lender was sizing to, I mean, they had to take a 6.5 cap. They wouldn't go below 6.5 cap. They'd lend 75% off of that. But once you go do that math, it just didn't make sense.
Right.
So that's usually why it winds up really only working with lower leverage properties, and typically bigger, more institutional garden style complexes or the high rises.
Yeah.
While there are a number of lenders that will lend $5 to $10 million of loan amount, where you get most competitive for cost of capital is going to be north of 25, north of 30 on the bigger institutional product. In which case now your cost of capital is, it's in the twos. Wow. So you compare that to the agencies. You compare the ease of execution, the fact that you have a balance sheet, the fact that you have a known servicer. Yeah. I mean, that's where that gets competitive. But 7 times out of 10, that the product just isn't going to fit a life company. Now, on any given transaction, I'll still size it up to a life company sizing and make some calls to make sure that we are checking all the boxes. But 6.5 times of those 7 times out of 10, it winds up going to the agencies.
Yeah. I mean, it just really would make sense if you already were going to plan on putting 40% down and you want to like more flexibility, then this is a good program for you. And I mean, it's not that much flexibility, but maybe more than the agencies. At least
it is, because you do have a point of contact. It is the life companies. They are portfolio lenders. They are keeping that loan on their book, right? So it's their loan. So if you need an accommodation, you don't have to call. Now with the agencies, for example, when if you had an issue with one of your loans that that we originated together, you could call me. Yeah. So that's a little bit different. CMBS obviously is a whole other animal where you're calling a completely third-party servicer that probably hasn't even looked at your loan until you called them. But with the life companies, it's still very much a relationship, because that loan is kept on book, and CBRE or really any of the intermediaries for the most part does have that servicing portfolio. So you do have that primary point of contact, which, if I brought you to a life company, you could call me, in addition to calling the actual portfolio manager who, is looking at that loan pretty frequently.
Yeah, makes sense. And then I think probably one more like permanent option I had thought of was just, again, through a bank where they can get competitive on rate. A lot of times when they introduce a swap product, so we've done a few of those where these weren't apartment deals because we've just gone to the agencies, but it got actually pretty close to that where we were able to get 10-year fixed, bank money, and then the bank went out and they bought a swap. And on one of those, when we sold the property, we got paid $50,000 on payoff because it was,
If it goes the right way.
right?
Yes.
Rates move whatever direction they need to go to have your swap worth something. So, that was interesting because we had no idea what the payoff was going to be in terms of the fee. Because the actual loan, there was no prepay fee because they, for the bank, it's like a floating rate product,
Right.
and then which is whatever cost to break your swap. And then on that one, we were getting paid to break it.
That is certainly an option. The negatives to that is if you are looking for longer term money, often you don't want to tie up capacity with your bank.
Yeah, good point.
And really reserve that money for more traditional bank type transactions. Now, that being said, if that swap is priced competitively enough, well, now it might make some sense to use that capacity. But between the recourse considerations and the capacity considerations, typically that's not one of the first things we look at.
Yeah.
But to your point, it does serve a purpose under the right circumstance.
Yeah. And when you say capacity, like banks, they have a legal lending limit. And then once you're at that, they can't extend you more money.
Exactly right.
Yeah. Because with that bank, we did hit the limit once and we were under contract on a deal. And they were like, okay, we're
at our limit.
We're at the limit. We didn't realize this. But thankfully we had at a place I worked prior, we're doing a bunch of loans with a bank and their contact was the president. This is in Minnesota. So then I called that guy and he basically got us a loan in less than a month.
That helps.
Totally delivered. So yeah, that was a good, that one I'll always remember. Maybe then just jumping back to stuff related to loans, like what I had mentioned, kind of maybe working sort of like back to front or whatever, thinking about the prepay when you're originating. Any other stuff that you can think of? Like this is like, I'm sort of answering the question, but I would say if they're asking me like, debt service cover, prepay, like what sort of things as a borrower want to be thinking about that maybe are like less common to be thinking about when you're originating a loan?
I think again, just matching up the loan product with the business plan is the most important thing. And that is a very different answer depending on whether you are a single investor who owns a single 5 flat, if you're a middle market investor, if you're more larger scale middle market, or for institution, right? That's fundamentally each one has a different investment philosophy. So understanding the different products, not necessarily rushing into one just because you filled out a form on a website and you have 14 different brokers calling you saying, I get you this, I can get you this. Understand what the product is. And fundamentally beyond that, the real estate underlying it is obviously important. Just because you can get a loan at full term interest only doesn't necessarily mean you should.
Yeah.
It doesn't necessarily mean you should put it on one particular property.
Right.
Not that it's bad to engineer a return because there's a time and a place for that. But if the deal only makes sense because you can get full term interest only, maybe you should reevaluate.
Yeah. And that's actually something I've wondered now is, cap rates have compressed so much, but then at the same time, the debt funds are getting way more aggressive, like all the capital's getting way more aggressive. So then, it's more comfortable to pay a 3.5 cap. And, the deal we were looking at, we were talking about with the A and the B piece, that was in Dallas, like more comfortable to pay a 3.5 cap in Dallas if you can borrow 10-year interest only in the low 3s from, I called it a debt fund loan, but then what would you call that? Because it's like debt fund and life company. So then,
yeah, I would just call that an AB loan,
okay,
for lack of a better term. And now in that instance, and to your point, I think the markets in which you're looking, you're there for a reason, because of the rent growth, because of identifying opportunistic properties where there is upside. I mean, if you correct me if I'm wrong, but I would doubt that you would just go buy a 3.5 cap deal if you know that in 10 years from now it's going to be a 3.5 cap deal.
Right.
And that's just, again, you're not a pension fund. Your cost of capital isn't 1%.
Right.
So you're looking opportunistically for rent growth or NOI growth, however you may get there. I think that's different than, again, putting an IO deal, a full-term IO deal on an artificially low cap rate transaction. that I think gets everyone in trouble. And not unlike what happened back in 2007, 2008, when the conduits at the time were sized into a 1.0 cover at 80% leverage and didn't really care what happened tomorrow. Well,
Right.
we all know what happened when tomorrow came.
Yeah, because if you got a debt fund loan and you're sizing to a 7 debt yield, in 3 years, and then something big changes, and you needed to, all this rent growth, all this to be at a place you can refi the loan at a normal like loan sizing. Right now, you're stuck. You got to sell, or you're, if the market dropped, then you're even stuck from selling now. So yeah, there's definitely risk to that.
Exactly right.
So yeah, and we're in these markets. Not if you bought at a 3.5 cap and then cap rates stayed the same for 10 years, that deal actually might not look
You're
so
right.
bad.
You're
but
right.
we at least don't underwrite like that. If we were in that deal, we're going to assume that it's going to go up to at least a 4, over 10 years. But what's interesting, and especially in the places where rents have ran up so much in the last year, there's a lot of loss to lease, meaning just the rents are below market. So then, you might be going in at a 3.5 cap, but you just put the rents to where they would be today, and then you're already over a 4.
Right.
That's now all of a sudden now like you're getting to a cap rate that's comparable to some Midwest states. We've looked at deals in Wisconsin and Minnesota and other places around here as well, and those are in the 4 caps.
Sure.
And then, so we've really liked those, the growth markets where you're finding a deal where there's loss to lease, because then you can get it to a 4 something cap year 2, and now instead of being in Wisconsin, you're in Phoenix, and then and there's a different rent growth picture from there. So that's been our strategy and what we bought. Where you can't really make the numbers work for what we're trying to do, just buying a stabilized deal.
And you do have to, in today's market, I don't want to make it sound like engineering a return is a bad thing, because there is certainly appropriate circumstances where that's right. But when in a market where it is as competitive as it is, that you do need to find those opportunities where you can, and finding, I'll call it a hidden opportunity, and I don't necessarily love that term, but a hidden opportunity in that, whether it's below market rents, or knowing that if you do add a washer and dryer, you're going to pop rents $200, or whatever the case may be. You do have to go find those opportunities where you can, both on market and off market. And I have talked to people on the phone before who call and say, I was given your number. I want to get into investing. I want to buy anywhere from 5 units to 25 units. I have however much equity. Where do I find them? So, well, that's the issue, right? To go off and find those deals. That's a full-time job.
Yeah.
And by the time you look at the listings, for the most part, with all due respect to the brokers who have been on the show before me, and they're very good at what they do, but it's because they're very good at what they do that those opportunities aren't very lucrative.
Yeah.
Right.
Yeah.
To really make the return that makes your investors happy, by the time that it gets to the brokerage community, they are good, and they will milk every last dollar in purchase price for their clients. Well, that's as an investor, it takes more than that. You really need to almost have a full-time staff finding those off-market deals to make those returns happen.
What about, I think we kind of touched on different types of deals for a second there, but like, let's say you do have a deal and we're gonna present it to the debt market. Like what should a borrower be doing kind of in terms of how they present their deal, or what kind of advice would you have for them?
First and foremost, know your deal. It's important to know your deal, not only to know the pitfalls or opportunities in any transaction, but it's also, if you're out talking to equity or talking to debt or talking to an intermediary, the more you know your deal, the more confidence you have in your deal, the better that you can articulate what the intent is, what is the opportunity, what are the challenges. That is first and foremost the most important thing. If you just have a deal and you bring it to a lender and say, here, what do you think? Everyone is extremely busy right now. Yeah. And if there's very little thought or presentation put into a transaction that's proposed to a lender, you're gonna get from them what you give them. Now,
makes sense.
That's part of my role as well, right? So when I go to my lenders, I do put together a package. I will look at a transaction. I'll look at a borrower's pro forma. I'll look at their assumptions. I'll ask some questions. Okay, what do you think about this? Why are you coming up with this? Where'd you get this? Just so that not only do I understand the deal and I can in turn sell it, but that when the lender is asking me questions,
Yeah.
I don't have to go back every single question to the borrower and saying, okay, what about this? What about
Yeah,
this?
you've
What
done
about
your
this?
homework on it. And
So make sure you know your deal and you do your homework going in. Now, that's not to say that when you have a conversation with me specifically, you have to have all your ducks in a row. My preference as an intermediary, as an advisor, is to be brought into a deal early. That's where I can add the most value, because
Yeah.
I can help you come up with some of those questions that you need to be asking and help tailor ultimately what that, again, lack of a better word, sales pitch will be to the
Yeah.
lender. Because it is a little bit of a sales pitch.
Yeah, and I've explained this point to the other people here, where if it's going to you, like it doesn't need to be perfect yet. It's like you could send another one, if it's pro forma or model or something. Whereas if that was to your directly to the lender, well, now they have it. This is, then they'd be like, why did the expenses drop and the deal's better now? And well,
Exactly
it's because
right.
we were, we would say it's because we were still evaluating it, but they're thinking, well, okay, which one should I use now?
Right.
So you don't want to be sending too many things once you're ready to go. But yeah, for you, we're coming to you for advice and what option should we go with, and then it's presented to the lenders.
That's right. Now, and that's not to say that you can't have preliminary conversations. And that sometimes there are transactions that fit outside of that formulaic box, right? Where you just need to go have that conversation. And that happens all the time. And then we'll go and we'll preface our conversation with that lender, say, this is a work in progress. We just got the information. We're still figuring things out. But generally speaking, here is the sketch of the deal. And a seasoned lender will understand that and be able to give the feedback that that I need to then in turn start coming up with, okay, what does it ultimately look like? But still, you need to know, maybe not to the decimal point, know your deal by the time it goes out the market, but you should still know your deal. And I'll say that's one thing that you and your team do exceptionally well is, even I think during the evaluation period, to get to the point of, okay, is this a deal that we share outside this office, or do we just kill it?
Right.
You've already digested that information and looked at the supporting information in the market. And to your credit, your team does a very good job with that.
Yeah. We're not sending deals that we're like thinking we might not pursue. Yeah, typically where we do ask a lot of questions to figure out how the loans are sized, because then we just can do it on our own initially, and then we don't need to ask every time like, oh, how does that work with the debt fund? And then we just kind of can model it up. So nice. Yeah. That, then I think, what about, so, okay, that's how to position your deal, but then what about how to position yourself as a borrower? Because one thing actually in the example, when you were saying someone new calling, saying I have money to invest, like what would you recommend? Actually, what was going through my head was where I thought you might be going with that is, well, you need some sort of track record typically to get a commercial loan. Like it seems, so then that, well, I guess I don't want to answer the question. So yeah, how can borrowers like best position themselves?
No, you were headed down the right path. So those first couple of deals as a borrower, it's going to be with your bank. It just is. Or you're going to be a partner with somebody else on a deal. Because the bank is going to be looking at you as a client, not necessarily as a real estate investor. And they'll say, okay, well, he's never done a mortgage loan before on a property like this, but I know him as an operator.
Right.
I know him as a client. He has the financial wherewithal. Once you have done a few of those, then you can start getting into more of these institutional programs like Freddie Mac. Freddie Mac, for example, does have a requirement that you do need other multifamily properties in your portfolio.
Okay.
And can you get a waiver if you only have one? Yes. A waiver if you only have two? Yes. Well, they like to see 3, 4, 5, just to know that you have the expertise in operations, to make sure that going forward you're going to be able to maintain the cash flow needed.
Yeah.
To if there is a blip in leasing, that you can weather that. You've seen that before in your in your history. And then in addition to that, there are, like any other borrowing requirements, there's going to be FICO minimums, there's going to be net worth and liquidity minimums. With the agency specifically, net worth should be equal to at least the loan amount, with liquidity equal to the lesser of 10% of the loan amount or 6 months of debt service. or gets the greater of, just to make sure that, again, even though it is a non-recourse loan,
Yeah.
that that lender wants to make sure that should something happen, whether it be a capital call event, deferred maintenance issue, whatever the case may be, that the sponsor has the wherewithal to right the ship.
Yeah, and then that's the reason why, I mean, some early on, like a lot of people, they partner up. You know, maybe one person has, they have the deal, the other one they have already owned multifamily, the other one has a balance sheet where you can you could group that together as well, right?
Mm-hmm. That's exactly right. If you have more than one sponsor, you can be co-borrowers on the deal, but and not that I want to dissuade anyone from multifamily investing, but it's a full-time job. I mean, it really is.
Yeah, it's
and to the extent that you want to begin growing your portfolio, you get to a certain point where it needs to become your job.
Yeah.
To have a large portfolio of especially multifamily, because unless you're loading off 100% of the management, both asset and property, to somebody else, then you need to be able to have the time to go through and deal with tenant issues, deal with property issues, find new deals. I mean, as we just talked about, finding deals is a full-time job.
Yeah.
So in that instance, if you don't have that, then, it might be better to invest with somebody in a fund with a group.
Yeah, makes sense.
That's who does have, that manpower and that expertise.
Yeah, and you can, I'm sure, learn a lot too as a LP in people's deals.
Yes.
You see what they're doing, how they set it up. What about, I guess, for, Fannie and Freddie or these other lenders we talked about, do they have, I guess none of them have like a requirement you need to be full-time or anything. It was just sort of a few of that property type was a requirement.
Correct. You don't need to have a website or a long resume of real estate investing, but it does help to have experience. It's a requirement to have at least one or two other assets in your real estate owned schedule, but it does help beyond that to have larger experience. And maybe that's just working at a larger real estate firm.
Oh, okay, nice.
But just some, there's, over the years I've talked to a handful of physicians who have put together a decent size piece of equity, and they want to get into real estate investing, and that's fine, but that also, it does make it a little bit more difficult to transact for them. Yeah, because they're off doing their doctor thing most of the day, and we have to schedule everything else around that.
Yeah, that would be difficult. And then especially those first ones, they need to go the bank route anyways.
Correct.
Great. Well, yeah, Steve, this was a lot of fun. I mean, I think this is good stopping point. So let's leave it there. I mean, how can viewers, listeners get in touch with you if they want to learn more about what you're doing or have a loan they need placed? Yeah.
No, I appreciate you inviting me in. This was fun. Hope to do it again sometime. And I'm always happy to talk with people through an existing deal, a potential deal, just questions. You can reach me at email is probably best, steve.kundert, Kundert at CBRE.com. I'll get back to you right away. And like I said, the sooner that we can begin discussions on an asset, the more we can help.
Yeah. And then in terms of like the cost, I mean, there's the cost is when it closes. There's no cost to talk to you. That's
great. Yeah, I get paid on at execution on closing a loan. As I mentioned, I earn my fee prior to that. That advisory work, that's really what you're paying me for. Yeah. As I mentioned earlier, anyone can go out for the most part and get a loan, right? That's just not necessarily what they may be good at, right? It's like, I could go off and I could buy assets myself. That's not what I'm good at. I'd rather give my money to you.
There we go. Perfect. All right. Well, thanks, Steve. Appreciate it.
Thank you.
Great job.
If you learned something from today's show, leave a review and hit that subscribe button wherever you enjoy your podcast. Dive deeper into real estate investing on Brenneman Capital's website, brenneman.com, where we have numerous free resources and information that can help both active and passive real estate investors. Accredited investors can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Brenneman and guests as of the date of recording and do not purport to reflect the views or opinions of Brenneman Capital LLC and its subsidiaries. Views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities. The speaker cannot be held responsible for any direct or incidental loss incurred